this video, I will explain why markets could soon explode higher to the upside. As I've said here on this channel many times now in the past couple of weeks, nothing has really fundamentally changed for markets, okay? I've said this time and time again. It sounds very redundant here on this channel, I know, but people need to understand this. Nothing changed. The only thing that happened is markets sold off a bit, okay? Now, what do you normally want to do if markets sell off but nothing changes? You normally want to buy that, okay? Now, what has happened in the past couple of weeks is really tactical, okay? It's profit taking and it's tax loss harvesting. Starting off tomorrow, tax loss harvesting is over. There is no more tax loss harvesting. And now everyone's going to be repositioning for next year. Considering that nothing changed, we still have the same bull thesis that we had before, right? Where are investors going to position their portfolios for 2025? And that's really what I want to talk about here in this video, is where the gains in 2025 could be most concentrated. I don't think it's in the S&P, and I even don't think it's in just the NASDAQ on a headline basis. So I will share with you the specific stocks and sectors that I like the most heading into 2025. Now, first and foremost, again, nothing has changed with the bull thesis of our markets. It remains the same. As I just mentioned, this is really just tactical tax loss harvesting and some profit taking into year end, following the last 2 years of big gains. And I think you're going to see a lot of repositioning, okay, into different sectors. I think small caps and cyclicals are going to be a beneficiary of that. You've seen the Dow and the Russell outperform the NASDAQ by a lot on Tuesday. Tuesday was the last trading day of 2024. Now, beyond that, beyond just, whatever sector that's going to win versus the other, historically, you want to be buying this market right now, okay? And I've talked about this plenty of times here on the channel, and I will go ahead and do so again now. The percent of stocks trading above their 50-day moving average is at 32.77%. So 67.2% of all stocks are in a downtrend. When 67% of stocks are in a pretty severe downtrend, like below their 50-day moving average, you want to be buying that weakness anytime you're in a bull market and you get to these levels. Okay, it doesn't happen often, and every time that it has happened during a bull market, it has been a good buying opportunity. Okay, now if you're not in a bull market, it's not a great buying opportunity. Okay, or it doesn't at least have to be a good buying opportunity. Okay, now 2022, great example of this, where you would get to these low levels, you would have a bear market rally, you'd rally a bit, people would think the worst is over, and then you'd come down lower. And then you'd go through a bear market rally again, and then you'd come down, you'd fall lower, and then you'd kind of continue this pattern. But anytime you're in a bull market, like even after COVID, right? This is April of 2020, you were at very low levels, obviously great time to be buying. You shot up, you came back down. By September of 2020, you had a bit of that second wave of Rona fear. It was a great time to be buying here, and this is when 29% of stocks were trading above their 50-day moving average. Like 70% of stocks were in a downtrend. It was a great time to be buying, right? You bought September 2020 before the craziness happened into 2021. You did pretty well. Okay, and even more recently in 2024, in April, S&P was down 7% at, about 30% of stocks trading above their 50-day moving average. If you bought then, you did well. If you bought on August 5th, when 31% of stocks were trading above their 50-day moving average, you did pretty well. And now today, you're back down to those levels. Now, if something had changed, if there was some big new information and, there was a reason for stocks to be declining the way that they are, then I would say you might want to wait and see what's going on, considering markets are at generally pretty high levels. Now, big tech is at high levels, small caps, value, cyclicals, a lot of those stocks are not. A lot of those stocks are at multi-year lows, okay? And I think that's where some of the largest opportunity is. We'll talk about that in just a moment. So I don't think you necessarily want to go out and just buy everything. I don't think big tech is going to, be the real winner that it has been over the past couple of years. I think the leadership will change in 2025. And there's one specific area that I'm very bullish on. But before we get to that, the CNN Fear and Greed Index is sitting at, previous close was 27, okay? 27. You are almost in extreme fear. Anytime you are in a bull market, CNN Fear and Greed Index is in extreme fear, you want to close your eyes and start buying, okay? You've never lost money, at least in recent history, buying stocks in fear or extreme fear during a bull market. We are in a pretty interesting period here, especially in the beginning of January, because we really don't have any earnings. You don't have much for earnings at all this week. You don't have much for even next week. Starting on January 15th, you're going to get the bank earnings that are going to come out. But let's face it, those are probably going to be pretty good, okay? Some people might be a little bit more concerned about tech earnings, but that won't be coming out for another, 2 weeks beyond January 15th. So, we have a lack of earnings. You don't really have any economic data. Also, tomorrow morning, you are going to get initial jobless claims. I mean, that's pretty straightforward. If it's low, that's good. If it's high, that's bad. Assuming all things come in pretty normal there and there's not a huge move in either direction, up or down, I mean, you really don't have much. On Friday, you have ISM manufacturing PMIs. That's it. Even next Monday, January 6th, you don't have anything. Tuesday, you have the JOLTS job openings, ISM services, PMIs. That will be important. On Wednesday, you have the FOMC minutes. On Thursday, you have initial jobless claims again. And on Friday, you have non-farm payrolls and the unemployment rate. So really, besides that Tuesday data of next week, it's really just Friday, January 10th, that has the big data. So over the next 10 days or so, there's not a whole lot that's going to, I think, derail this market or really be a material negative catalyst at this point. Now, I think markets are so negative right now that nothing could actually be positive. Just the repositioning back into stocks for 2025 could be very positive for our markets. Now, certain sectors are going to benefit more than others. I like small caps right now as a higher risk, higher reward kind of trade. If the S&P is up 15% next year, small caps could easily be up 30 to 40% next year. This is one of the longest losing streaks for small caps year after year after year that we have ever seen before. And I do think we are at a place, okay, where expectations are that inflation is going to be very sticky. The Fed's not going to be able to cut rates. When I think about a surprise to that, I think the surprise is potentially to the downside. I think if we do get a surprise and things do not go exactly according to plan, which they really never do, what's most likely to happen is inflation surprises to the downside versus surprises to the upside. Okay, that's my personal opinion. There's many reasons for that. You could call it Doge. You could call it just expectations of inflation. You could call it, more stringent immigration policies, which all of those will tend to be maybe a little bit more deflationary, and also just innovation, right? Tech innovation continues to drive down prices. As long as we do not have some kind of port strike or shock to the supply chain, I don't see the risk is that inflation, goes higher than expected. Okay. So if we're thinking about like a bell curve here, I see the odds of a surprise to the downside higher than the surprise potential to the upside of inflation. Thus, the Fed could actually be cutting rates more next year, and that's really the bull thesis for small caps. And I know a lot of people have grown accustomed to the Fed really cuts rates more or less depending on how the economy does. But that's not exactly how it works, right? If inflation comes down more than expected, but the economy does well, like we've seen in the last 10 years when we didn't, 15 years, 20 years when we really didn't have any inflation, the Fed can lower rates because inflation falls, all else equal with the economy. Okay, so I think that's a positive potential surprise to small caps. And if I'm thinking about probabilities here, I think there's a higher probability than not that we get a pleasant surprise for small caps and the inflation story. Okay, so that's one area that I could see the bullishness on. Now, cyclicals, small caps, industrials, I think that's an interesting area as well, because I think actually when you look at the economy, you haven't seen great things, right? I think some of the AI investments, some companies' investments have really boosted up that GDP number. Whereas if you talk to the average person, they're not doing that great. They're definitely, not doing as great as they were pre-pandemic, just from what I've gathered, from people I've talked to, from people's, personal finance situations. I think that could start to change a bit as wages start to catch up next year, which could be a boost to cyclicals, maybe industrials, some of the areas, materials, even if demand picks up from consumers. Okay, so consumer stocks could do a little bit better under that kind of narrative. Now, the best area that I like for 2025 is really a group of different areas. There can be single stocks in different industries that fit this category, but I'm calling it AI appliers. Okay, this is not NVIDIA. This is not AMD. This is not semiconductors. These are really not big tech companies either. Okay, AI appliers, companies that are using AI, creating a product or service that is actually gaining traction from it. I can name you Elastic NV, MongoDB, Tesla, Snowflake, Palantir. Okay, those are 5 stocks off the top of my head that I don't actually own Palantir, but I own the other 4. Right? Those are the kind of areas that I like the most for next year. Your AI appliers. Especially Tesla, MongoDB, and Elastic. Those companies just had great earnings, and Tesla has some, delivery numbers coming out this week, and we'll see what's going on with that, how much that influences the stock. But companies that are doing something, creating something with AI, that is where I think you want to be versus semiconductors, versus big tech, even, versus small caps, industrials, or cyclicals. I think the AI appliers, a lot of your software names, are going to be the biggest winners of next year. And good news is a lot of software stocks, MongoDB, Elastic, besides Tesla, those stocks have not done well. Like MongoDB is one of the worst performers on the NASDAQ this year. I don't really know why. They just had blowout earnings a couple weeks ago. I think that is an opportunity to buy the weakness for next year, and that is where I am positioning a good chunk of my portfolio. Now, I also like data centers for next year. Data center demand is going to be off the charts. Now, there's high quality data centers, there's lower quality data centers. Now, I say lower quality data centers, it's not really lower quality, more like it's just higher risk. Okay. Like Applied Digital. That it's a company that I think is very much high risk, high reward, and it's a very volatile stock, but it's an upcoming, what I think will be a winner in the data center space. They already have a bunch of clients with their already existing infrastructure. They're building out a couple other data centers right now and going to be one of the largest data center providers in the world, I believe, over time. Okay, that stock, it's done well recently, but it's still down a lot from its all-time highs. I think a name like that could make a lot of sense, but there's other data center plays that that could also, you know, fit that same category. So really, AI appliers, data centers, that is where I feel most confident for 2024. And then I would say industrials, like cyclicals, below that. I would say small caps below that, and then I would say like Mag 7 below that. Right? Could Mag 7 do well next year? Of course. Am I super confident that they're going to do great next year? No. Okay, that's not where I would want to be positioning new capital in this market. MongoDB, Elastic, Tesla, Palantir, Applied Digital, right? Out of semiconductors, I do like Novartis Semiconductor. It's less than $1 billion market cap. It's a small company. They're kind of cyclical in nature. They have like 300 different patents. They're already, you know, creating products and like fast chargers, right? They have ultra efficient semiconductors. They're hopefully gonna get into the EV segment and a lot of different segments over time. High risk, high reward kind of stock, but something like that could even do well next year, especially if small caps overall do well, which that's kind of a bet for. So I like these areas. That's where I'm positioning. I don't like big tech at all. Take that for what you will. Big tech has been the leader over the past 2 years, and you never know. They could be the leader again next year. Ladies and gentlemen, that is it for this video. Let me know your thoughts down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.